Unveiling the financial alchemy. Discover the secrets behind how banks create money, influencing economies, and shaping our financial world. Hello everyone, and welcome back to our channel. Today we're diving deep into the fascinating world of finance to unravel the mystery behind how banks create money. It's a topic that impacts all of us, yet many people aren't aware of the intricate process that takes place behind the scenes. So, buckle up as we embark on a journey to demystify the magic of money creation by banks. Definition of money creation. Let's start with the basics. Money creation refers to the process by which new money enters circulation. Traditionally, people might think that the government is solely responsible for this, but the reality is a bit more complex. Banks play a crucial role in this process. The Fractional Reserve System. Now let's delve into the heart of the matter. The Fractional Reserve System. At its core, this system mandates that banks reserve only a fraction of the total deposits they receive. In many cases, this fraction is set by regulatory authorities. For instance, if the reserve requirement is 10%, a bank needs to keep $100 as reserves for every $1,000 deposited. Consider this scenario. You deposit $1,000 into your bank. As per the fractional reserve requirement of 10%, the bank is obliged to retain $100 in reserves. This leaves $900 that the bank can now lend out to other individuals or businesses. And here's where the magic, or rather the complexity, happens. Money Multiplier Effect. Enter the Money Multiplier Effect, a key player in the expansion of the money supply. The $900 loaned out doesn't sit idly. It gets spent by the borrower. Let's say the borrower uses it to pay for goods and services. The recipients of that money, perhaps local businesses, then deposit it back into their banks, creating new deposits. Now, this $900, which started as a loan, has become a new deposit, and the process can repeat. The bank can use a portion of this new deposit, say $810, to make another loan, leading to further deposits, and the cycle continues. This iterative process, where each deposit serves as the basis for new loans and deposits, is the essence of the money multiplier effect. Through this intricate dance of deposits and loans, the initial $1,000 deposit has the potential to result in a much larger increase in the overall money supply. This interplay between the fractional reserve system and the money multiplier effect is fundamental to understanding how banks create money in our modern economic system. Creation of broad money. Now that we've unraveled the intricacies of the fractional reserve system and the money multiplier effect, let's explore the fascinating concept of broad money creation. Broad money refers to the total money supply in an economy, encompassing not just physical currency, but also various forms of bank deposits. As the money multiplier effect unfolds, the initial deposit of $1,000 ripples through the banking system, giving rise to multiple rounds of loans and deposits. With each iteration, the money supply expands exponentially. What started as a single deposit has the potential to generate a substantial amount of new money circulating within the economy. This process contributes to the creation of broad money, providing the liquidity necessary for economic transactions, investments, and overall economic activity. Understanding this expansion is pivotal in comprehending the dynamics of modern economies and how they can adapt to changing financial landscapes. Central bank's role. Now let's shift our focus to the overseer of this intricate dance, the central bank. The central bank, often considered the bank of banks, plays a pivotal role in regulating and supervising the financial system. Through tools like setting reserve requirements and influencing interest rates, the central bank exercises control over the money creation process. By adjusting these parameters, the central bank can either stimulate economic growth or apply brakes to prevent inflation, ensuring stability within the financial system. Reserve requirements and interest rates. Now let's dive deeper into the levers that the central bank employs to guide money creation reserve requirements and interest rates. Reserve requirements dictate the minimum amount of funds that banks must keep in reserve, ensuring stability in the financial system. By adjusting this requirement, the central bank can influence how much money banks can lend. If the central bank decides to lower reserve requirements, it frees up more funds for banks to lend, amplifying the money creation process. On the other hand, increasing reserve requirements puts a damper on lending, curbing the expansion of the money supply. Now let's talk about interest rates. a powerful tool in the central bank's toolkit. By manipulating interest rates, the central bank can stimulate or cool down economic activity. Lowering interest rates encourages borrowing and spending, further fueling the money creation engine. Conversely, raising interest rates makes borrowing more expensive, slowing down the creation of new money. These dual mechanisms, reserve requirements and interest rates, allow the central bank to fine-tune the money creation process. It's a delicate balancing act, requiring a nuanced understanding of economic conditions and potential risks, critiques, and concerns. While the fractional reserve system and central bank interventions are the backbone of modern money creation, they are not without their critics. One prominent concern revolves around economic instability. During periods of financial stress, the rapid contraction of the money supply can exacerbate downturns, leading to a vicious cycle of reduced spending, investment, and employment. Another critique pertains to the distribution of newly created money. Critics argue that the benefits often accrue disproportionately to certain segments of the population, potentially widening economic inequality. Additionally, the reliance on debt-driven money creation raises questions about the sustainability of such a system in the long run. These critiques underscore the complexities and challenges inherent in the current monetary system. As we navigate the intricate landscape of money creation, it's essential to consider these concerns and explore potential avenues for a more resilient and equitable financial system. Digital money and the future. As we traverse the ever-evolving landscape of money creation, the advent of digital currencies emerges as a pivotal player in shaping the future. Digital money, represented by cryptocurrencies and central bank digital currencies, CBDCs, introduces a new dimension to the traditional banking system. Cryptocurrencies like Bitcoin and Ethereum operate on decentralized blockchain technology, challenging the conventional banking model. Their decentralized nature allows for peer-to-peer transactions without the need for traditional intermediaries, potentially reshaping the dynamics of money creation. On the other hand, central bank digital currencies are digital versions of a country's official currency, issued and regulated by the central bank. These digital currencies aim to enhance efficiency, reduce transaction costs, and provide more direct control over monetary policy. The rise of digital money poses both opportunities and challenges. On one hand, it offers the potential for a more inclusive and efficient financial system. On the other, concerns about security, privacy, and regulatory frameworks need careful consideration. And there you have it, a simplified explanation of how banks create money. It's a process deeply ingrained in our economic system, impacting everything from daily transactions to global financial stability. If you found this video helpful, don't forget to hit that like button, subscribe for more content, and share it with anyone who might find it interesting. As always, thanks for tuning in, and we'll see you in the next video.